Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Hope everybody's having an awesome morning. Hopefully your trading has been going well. Yeah, I just want to welcome everybody here and also want to give a shout out to everybody in the recording as well. Just want to say hello to you guys. Hope you're having an awesome day wherever you are and whenever you're watching this. But let's go ahead and jump into this. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, so let's go ahead and talk about today. I thought we'd go over chart patterns. It's been something we've talked about recently, and I've got several different patterns I'd like to share. This will help you do a couple of things. When you can recognize patterns in the market, you'll create pattern recognition, which will allow you to kind of determine maybe where the market's going, what direction you should be thinking about when you see these types of patterns. Now, a little context with these patterns. These are very powerful and they can help you trade very well. However, I do not want these patterns to become the only thing that you use in your trading, right? It's very important that you use these patterns as a type of secondary analysis on top of the normal analysis that you do. I want you guys to rely on supply demand. I want you to look for different zones where the market is likely to reverse or continue. I want you to continue to look for supply and demand boxes from the institutions, that kind of thing. Okay, that's going to help you become a much, much better trader. Now, can these be useful? Can this give you confirmation? 100%, absolutely. And that's what I want to teach you today. And you're going to love them because I've taken a lot of really great trades using these. I've used them in the stock market. I've used them in the Forex market, commodities, cryptocurrencies. You can use these patterns as recognition and they're universal, which is really nice. So a couple of patterns. These are some of, there's dozens and dozens of patterns out there, but I have 20 here that I believe are some of the best ones to be watchful of. And the most basic, I would say, is like a double top, double bottom. Then you've got the triple tops, triple bottoms, head and shoulders, descending triangles. You've got wedges, rectangles, pennants, flags, and other types of various triangles that we'll look at today. So I'm going to, I've got it over here in this other presentation. Let me go ahead and start here. So I actually gave this presentation first time at San Francisco State University. So I've been trading and I did it back in 2018. So I've been trading these patterns for a long time. And again, like I said, they've been around since the beginning of time. Since trading has been a thing, they've been around. So it has to do with human psychology and things like that. But here's the first one. Double top pattern is where the market comes up right here, forms a high, comes back down, and kind of forms a neckline right here, and then comes back up and hits it again. Let's see what else is going to see. So it comes back up and hits this resistance again, and then ultimately rejects and comes back down. And typically traders can place an entry, a sell stop order at the neckline here. They can stop out up here and target somewhere down here at a supply or demand zone. So anyway, it's a powerful little pattern. Here's it in practice. This is kind of what it would look like with a real life example. You've got a market that comes up, comes down, retests, fails, and then just gets rejected. So you're looking for that type of phenomenon. The double bottom is the same thing, just on the opposite side. You're looking for a market that comes down, forms a support, creates a neckline, tries to go again, fails, and then ultimately decides to go to the upside from there. Okay, so that is a double bottom. Here's it in practice. This one's not as good, but nonetheless, it's still there. You've got a market that forms down here. There's actually a double bottom here and here. You've got a low here and here, and then ultimately comes up. So you could use that one, but the overall picture of this market is a market that bottoms here, comes down, bottoms again, and then ultimately goes up from there. Okay. So you can, and again, typically these are found around supplier demand anyway. So you got a lot of demand in this area. So it only makes sense that the market just kind of shot up from there. Triple tops. Okay, these ones are a little bit more rare because obviously every triple top at one point or another, it was a double top and decides to be a triple top. So they're more rare. And that's actually one side note I'd like to share with you guys. When you have something that's more rare to find, they tend to work out better. So the more rare a pattern and you can recognize it and it shows up, the better that trade is, because double tops and double bottoms are everywhere, every day on every time frame. And so they're not, I wouldn't say they're, not every double top or double bottom is going to work out. Nothing's 100%. But when you can find a triple top or a triple bottom, I'd say they're a little bit better and they tend to work out a little bit more. Here's a triple top in I guess in life scenario. So you've got a market that comes up, forms a high, comes down, forms a neckline, comes up again, forms a double top, comes down, and then ultimately you have a market that tries one last time to make a high, it fails, it gets rejected, and then ultimately pulls back. And when I actually took this screenshot, it was in the middle of still pulling back. So my guess is that market probably just kept going down from the time I took this screenshot. Triple bottom is the same thing, just on the opposite side. You got a market that comes down, forms a support level, forms a neckline at some point. Usually that neckline is found at the 23% Fibonacci level, which we haven't really talked too much about Fibonacci's. I don't use them too much, but often the neckline will be found around a fib level, typically the 23% Fibonacci. But not that that matters too much. It's just in general that happens. Okay, and then the market comes back, hits for support, comes back up, hits the neckline, comes down, hits support, fails, and then ultimately decides to go the other direction. Here's an example. Here's a live example. You've got a market comes down, same thing, comes down again, tries, comes down one last time, and then ultimately goes up from there. So and then basically your entry on something like this would be when the market hits the neckline right here, either this neckline or this neckline up here, that would be your entry. So you could have bought right here, around right here, or if you wanted to wait, you could get in somewhere up here. And that would be a triple bottom example. Okay, and then you have a head and shoulders pattern. This is common, very, very common. Some will work out great and others won't. And it really just kind of depends on what the market's giving you. Really just kind of depends. So here is, and this one I'm going to spend a little more time on because this psychology behind a head and shoulders is really kind of a big deal. Basically, what you have is a market that comes up, it's ripping to the upside, and then it pulls back, usually to a 23% Fibonacci level, and then goes up one last time. But this is where it gets interesting. The market's coming up, and yes, it's making a higher high, but that high is not as far as the previous high went. So this went a long ways to get from here to here. And then this one pulls back and then it goes up again. And it just doesn't go up with the same gusto as the first one does. So it's just not as powerful, if that makes sense. And then it gives up 100% of its move. It comes back right here, gives up 100% of everything that it just created. So it worked so hard to go all the way up to here, and then it gives all of it back down to the neckline. That's a bad sign if you're a bull. If you're a buyer and that happens, you need to be paying attention to this kind of stuff because it may mean you need to exit your long position, your buy order, and maybe even flip the other way and go selling. But these are things you have to pay attention to. Then the next thing that happens with head and shoulders is you get a market that comes up to here to the shoulder line, right? And it completes the shoulder. You've got shoulder, head, shoulder. and it completes the sequence. And then this is really bad news if you're a buyer. If you're a buyer and this happens, this means that your last and final attempt to send the market higher fails. And if it fails like this, then good luck trying to send it higher from there, because all the sellers are on board and ready to send this market even lower. So you got to be watchful for that. And then basically the sellers are just going to take over, just absolutely take over. Here is an example of what one looks like. Okay. This one's actually kind of cool because you have this head up here. It's like the king of head and shoulders. You have a head up here and a shoulder here and a shoulder here. And then you also have this shoulder here and a shoulder here. So this was really kind of remarkable how this one worked out, because you got this nice move up, little move down, nice move up, pulls back all the way down to the neckline, comes up to the shoulder line, completes the shoulder sequence, and then just falls apart from there, right? Let's talk about reverse head and shoulders. It's the exact same thing, just on the opposite side. So you got a market that comes down, comes up to the neckline, comes back down, makes a head, comes back, gives everything back that it created on the head to the neckline, finishes the shoulder sequence, and then the bulls take over from there. Here's an example, right in plain sight. Okay, so you got a market that comes down here, comes up, comes down, comes back up. This one didn't quite make it back to the neckline, and then it comes down again to the shoulder line, completes the sequence, and then bulls have now taken over. You make a lot of money on that move right there. A lot of money. Yeah, you could, oh my gosh, you could make thousands and thousands of dollars on that move if you saw it and played it just right. My guess is that there was some institutional buy blocks down here in addition to the fact that it created a shoulder, finished the sequence, and then yeah, like I said, bulls just take over. Here's a rising wedge. Okay, now we're going to shift directions, talk about wedges. Okay, wedges can go either direction. Okay, it's a compression. Wedges are compression of price action. It's a compression of buying and selling. So you get a market where basically it has nowhere to go. It has to go, well, I mean, it has to go up or it has to go down, but it's just being compressed. Typically, these will go to the downside if they're pointed up. If you get a pointed up wedge, they will ultimately find their way down, but not every time. You got to be careful, because I've had plenty of wedges where I've played them like rising wedges where the market looks like it's going to go down and they actually go up too. So you got to be pretty careful with these. Here's an example of a rising wedge. Okay, nice market coming up, compressing, compressing, compressing all the way into the corner until it can't go anywhere. And then ultimately, boom, breaks out. Okay, this is a rising wedge example. And again, this one worked out great to the typical direction, which is to the downside. But sometimes these rising wedges, I've seen them break to the upside. So you got to be careful how you trade these. Here's a falling wedge. Okay, same thing, just on the opposite side. You could trade this bearish, you could trade bullish. Most of the time, it's going to go to the upside. So you definitely want to be ready for that when they do go up. Here's an example. Oh, let me explain why this is such a good example. This one's already built into an uptrend. You can see the market was coming up and it had a brief pullback, a brief dip in the market. And it's just kind of consolidating, comes into this wedge, into this corner. And yeah, it took off a little bit early and it kind of stagnated, but ultimately the market still went up. Okay. It still went up to the upside, which is the expectation, but kind of a cool example. But I like these ones because it's already built into an uptrend and you get a bullish signal in an uptrend. That's an even better trade to take than one of these that's built into a downtrend, because you're just counting on a reversal, a flat out reversal on that example. All right, guys, next one, bull rectangle. Okay, this is actually a pattern. Yes, it is. I know it sounds really simple, but it is a pattern. So what you have is a market, which, by the way, we're starting to talk about the continuation patterns. I really, really like continuation patterns. You're going to see why in just a moment. But bull rectangle is basically a market that comes up and then basically stays up. Okay. It just comes up here, stays up here, and then the idea is that it's just going to continue. It's just here for a pit stop. It's just here. It's just along the freeway, comes to a pit stop, and then it's just going to continue. Okay. Usually this will happen around the close of a market. So let's say, you're at the end of the trading day, you had a market that goes up all day. And then at the end of the trading day, it needs to kind of stop. So it just kind of consolidates sideways. And then at some point, the market's just going to go up from there. And usually it's just going to continue. It's just going to continue again its uptrend. It's going to continue that uptrend after, basically it's just going to continue the uptrend when the market opens again. So here's an example of one right here. So you got a market that's just up, sideways, probably during consolidation period, not a lot going on, maybe a market close type of thing, and it's just going sideways. If it's holding itself up, it's just propped up here and it's not really pulling back, that's actually a pattern. That's a bullish pattern because it means the market is willing to keep the market there. The sellers don't have control. The bulls, the buyers still have control over the market. And so this is a signal for you. If you missed this first nice move to the upside, this is a signal for you to be able to capture the second move to the upside up here. Okay. That's what this is all about right here. So it's actually a beautiful little pattern. It's something to look for. Here's a bear rectangle, same thing, just on the opposite side. This one's a signal to continue to push the market down. You've got a market that already came down during the day, most likely some news event or something that just pushed it really hard, and then it just kind of stayed down there, right? That's a bear rectangle. And then the market just, next time the market opens or you have volatility or whatever it be, then the market just continues to the downside. And here is an example. So nice big move to the downside, kind of a sideways consolidation. It's holding itself down and then ultimately finds its way even lower. Okay, this one wasn't as clean, but sure, it still just kind of drifted to the downside, which you can make plenty of money when the market's going down like this. Plenty of money. Okay, bull pennant. This is probably my favorite pattern, just pennants in general, bull pennants, bear pennants. When I trade in the stock market and I'm doing day trading in the stock market, which I haven't done a lot recently just because I've been doing so well in Forex. And plus I trade, I'm funded with FTMO, and as you guys know, I'm trying to get funded with my Forex funds for another $200,000 right now. So the bull pennant is a pretty awesome pattern that I would trade in the stock market. It's really awesome. And I think it's the king of all patterns, to be honest. It's my favorite. And maybe it's just because I've had so much success with it. But let me explain why I love this pattern so much. So the bull pennant works like this. You have a market that's coming up all day. You probably missed this trade. I mean, I would probably miss this initial move. But this is the king of all continuation patterns, in my opinion. So basically what's going on here is you have a market that's compressing. It's like this lava flow. It's a volcano that is just building pressure all the way up into its point of exit. And then all of a sudden it's got to release that pressure, and it does so in the continuation form. So you have a market that's already going up. So that's your signal that it wants to keep going up. And then it just compresses sideways, similar to the rectangle, but this one's even more special because it's creating pressure. Okay, it's actually going to a corner. It has nowhere to go. And so ultimately, when it finds itself to the end of the corner here, end of the triangle, it has to move up. So it's a very acute triangle, okay? Very long, it's elongated, and it has a very thin angle to it, or acute angle, and ultimately has to break out, and usually that'll be to the upside. Here is an example. Beautiful example right here. You have a market that comes up, holds itself sideways, and ultimately compresses. It gets really, really tiny, and then explosion. Okay. You can make a lot of money with these. Okay, you really can. And it happens in every market, stocks, it happens in Forex. What I actually was doing, let me actually show you a quick stock pattern or stock trading method that I was using only this pattern for. So what I did is I had a scanner on TD Ameritrade. They have a really nice scanner on Thinkorswim. That's their platform. And I would program the scanner to basically say, hey, scanner, when I wake up in the morning, you know, or when I'm ready to trade in the late afternoon or early afternoon, tell me what stocks are up 5 or 10% on the day. So these are typically penny stocks. And then I'd have a volume requirement. I would require that a certain amount of shares were traded on that currency or excuse me, that stock, so that I could get enough volatility. And then what I would do is I would just comb through. I would usually, out of the 13,000 different stocks in the stock market, I think there's 13,000 stocks out there. It used to be 9,000. Now there's 13,000 stocks in the US stock market. So that's a lot of stocks, but we have, how many currency pairs do we trade in Forex? We have like 27, 28 to pick from. Well, in stocks, you got 9,000, 13,000 stocks, right? A lot of confusion out there in the stock market. So I had this scanner that would help me find out which stocks were up, you know, an insane amount on the day. And then if I saw this pattern show up at the end of the trading day in the stock market on a penny stock, if I saw this show up, I would buy this stock and I'd hold it into tomorrow. I would buy, you know, a couple thousand shares and I would just, you know, keep that stock. And then when I'd wake up in the morning, typically this has happened. This follow through move has taken place and you'd make quite a bit of money. Now I stopped doing it just because I've been focusing on my Forex trading and my education that way, building my business. And sometimes stocks are kind of weird. Like, and the other reason why I stopped doing it was because a lot of times if penny stocks go up in a general down market, if the general stock market is down on the day, these won't work out no matter how good you trade them. So that's why I kind of flipped to trading just these in the Forex market. Just because in Forex, you can make money whether it's up or down, doesn't matter. Same thing in stocks. You can make money, you can short stocks too, but I really hate shorting stocks because stocks were built to go up over the long term. And so I really don't, I hate shorting stocks because you can get burned pretty bad. At least I have. So I've just kind of, Forex is kind of my forte and I've gotten really good at it. And I've shown a lot of people how to get funding from these different companies. I think it's the quickest way to, Forex is kind of the quickest way to earning an income in trading because you can get funding from all these companies, whereas a lot of people won't fund you in the stock market. There's a lot more funding available in Forex, a lot more. Okay. And it's easier to get funded in Forex. So that's why I teach Forex. Bear Pennant. Anyways, thanks for listening to my rant there. But Bear Pennant's the same thing, just on the opposite side. So here's an example. You got a market that pushes down right here, and then it kind of goes sideways, compresses into a corner, and then ultimately this one just kind of drifted to the downside, right? But how did you know it was going to go down? What's context, right? What was the context? Oh, the market was pushing down, and then it created the pennant. So in all likelihood, it's just going to continue down. Here's another really great one. This is called the bull flag. I love the bull flag pattern. Basically, the bull flag is just a pattern where market comes up, kind of holds itself up, but it's kind of slanted. So you got this slanted flag rectangle, and you want to, and this market ultimately is going to head to the upside. And you typically, a little side note or tip, when you're trading these bull flags, you do kind of want to have a market that's kind of you want kind of a thinner market where it's like holding itself. You want to, the smaller the flag, the better. If that flag gets wide, they typically don't work as well. Here's an example of one that worked out. Here's a, like I said, the candlesticks are kind of thinner together. That's a better example. So you have a market that pushes up, flag shows up right here, holds itself up, and then boom, market goes up from there. Here's a bear flag. It's the same thing, just on the opposite side. Market that pushes down, kind of slants up a little bit. It's an upside down flag. And then ultimately the market will find its way to the downside. Here's an example. Beautiful example right here, honestly. Nice move to the downside. Flag shows up. It's kind of an elongated flag. That's fine. Candlesticks are kind of thinner. And then boom. Nice move to the downside. Okay, here's an ascending triangle. This is actually what I traded last night on the Euro Pound. It did not work, unfortunately. However, I did get back into the Euro Pound, so we'll see if it works out this time, this go around, but I'm going to try again with the Euro Pound to see what we can get over the weekend, and holding it into Monday, maybe Tuesday, perhaps Wednesday. We'll see how long this trade takes. But here is an ascending triangle. So basically, an ascending triangle is a market that comes up, same thing, it's squeezing again, but it's got a flat line on the top, a nice horizontal line, and then ultimately finds its way to break out. And typically this is going to be to the upside. I have seen these, though. They have broken to the downside in the past, so you have to be kind of careful. Here's an example. You got a market that pushes up, okay, move sideways right here, and then ultimately breaks out to the upside, okay? So it just kind of compresses again, and then breaks up. Descending triangle is the same thing, just on the opposite side. You get a market that pushes down, and then you get a compression with a horizontal line holding it up, and then it just compresses into that horizontal line slowly, and then ultimately has to break. Here is a beautiful example. Okay, market. This one is kind of already pushing down. I don't know what the context was on this one, so maybe it's not as great of an example as I thought, but yeah, hopefully the context of this guy is already pushing down, and then this shows up. You got a flat support line right here, market pushing down, compressing, and then ultimately just the floor falls out. That's what happened. The floor just fell out, and it just comes down. So that's a descending triangle. And yeah, you are looking for the market to go lower with that one. Okay, this is the last one. It's a symmetrical triangle. Symmetrical triangles are like pennants. They're like descending and ascending triangles and wedges. But the thing about a symmetrical triangle is it has a wider base. Okay, so it's a little bit wider. And they don't always have context, so they can go anyway. So basically, it's just a flat out triangle that just appears out of nowhere in the market. It could have no context, it have some context, and they just show up, and then just be ready for the market breakout. It could break out in any direction. So here's an example. This one did have some context to the downside. You can see it's already kind of slightly pushed into the downside, and then this shows up. Okay. That's a symmetrical triangle. And yes, it did ultimately break to the downside as expected, and it was a breakout. So with this type of thing, you have to have, a stop loss up here, above these recent highs. And then you can enter at market, or you can enter through via sell limit, or sell stop, and just wait for the market to break down from there. So, anyway, and again, when we're taking these types of trades, guys, any trades that we take, you guys watch me take trades all the time. When we're doing these overnight trades, pattern recognition trades, or anything like that, we always want to maintain the integrity of a 3-to-1 reward to risk ratio, at least, because we are going to have losing trades, and we want to make sure that when we win on a trade, that the winner is 2, 3, 4, 5 times the loser, the potential loser that we could have, right? So definitely want to we definitely want to have much bigger take profits and stop losses, and I do that with all of these trades. Any example you see here, you could easily afford a 3-to-1 reward to risk ratio. 3-to-1 is just that magic number. I feel like get a 3-to-1, you can afford 3 losses and 1 winner. Just on the 4th winner, you break even. You can stay in business a long time if you do. Well, you'll make money, not just stay in business. Because, you know, most of these trades work out anyway, or at least 50% of the time. And even if they just work 50% of the time, you're winning 50% of the time at 3 to 1. I mean, that's a great reward to risk ratio, right? All right, guys. So I think that's it. Yeah, I think that's it as far as the patterns go. So if you have questions, let me know. Also, for those of you that are watching this on YouTube or watching this via the recording, let me know if you have questions below in the comment section. You can just, you know, I'll write back in the comment section if you have questions. Additionally, guys, for those of you that are watching this on YouTube, we have a live trading class that we do every day of the week. We trade what's called our banker's close or retirement trade that we trade every single day, Monday through Friday. This morning, we made 37 pips trading, which was super awesome. We had a trade this week on the CAD yen. We took on Monday. It was a swing trade, also using pattern recognition and using institutional supply and supply and demand boxes. Made $15,000 on a single trade this week on my Forex Funds account. So I'm always passing challenges with different prop firms. So if you're looking to pass prop firm challenges, this is the place to be, because I show you exactly how to pass those challenges. And you can literally even just take the same trades I'm taking to pass those challenges, which is really phenomenal. So all right, guys, I think I'm going to go ahead and wrap up with that. I really appreciate your attendance. And like I said, for those of you that are watching the recording, if you want to come to these live classes, sorry, I didn't mention this. You can join for free for 14 days. You can come to all of my live classes, basic trainings, everything that I do for free, 14 days, free trial. I charge as little as $87 a month for the live trading. If you want to come basic trading, it does cost $97 a month, but it is free for 14 days if you want to check it out. There is a link to that in the description below on YouTube here. So click that and you can start coming to these classes. All right, guys, thanks so much for coming, and we will catch you in the next video. Enjoy your weekend.